Welcome back to Alpha Recap. Marcus here. Markets closed May 15th with a pretty mixed tape, and today we're digging through the sector headlines so you can hear what mattered and why. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks. Glad to be here. Lots to unpack from the close. Big project wins on one side and legal and underwriting headaches on the other.
Let's start high level. Give us the one-line summary of the day.
Markets closed May 15th with what I'd call a neutral to cautiously constructive tone. Big capital deployments and final investment decisions pushed energy, materials, and industrials forward, while real estate, crypto, and some utilities faced fresh headwinds.
Okay, so CapEx up, policy and legal risk up in other places. Tell me about the CapEx headline grabbers first.
Sure, the standout headlines were very CapEx driven. A private raise of about $5 billion for a national security tech firm grabbed attention. A $1.2 billion plant commitment in Texas was announced. And then there was a $13 billion final investment decision for an LNG project. Those are the kinds of moves that ripple into materials and construction.
$13 billion on an LNG FID. That's huge. How does that show up in the market?
Big picture. FID stands for Final Investment Decision. It commits multi-year construction revenue to engineering firms, pipe and module suppliers, and steel makers. You start to see order book visibility improve for those suppliers, which is why energy, materials, and certain industrials outperformed on the day.
And that $5 billion private raise, that's the defense tech name, right?
Yes, an unusually large private capital infusion in defense-adjacent tech signals persistent private capital appetite for national security systems, which then benefits industrial suppliers and specialist materials vendors feeding those supply chains.
Big move.
Not what anyone expected.
Okay, switching gears. Materials had a good day too. What drove that?
Materials and mining were pushed by a few deal-driven headlines. A reported $239 million royalty transaction, new drilling programs, and rising demand for recycled resin. New recycling technology and project wins gave better near-term demand visibility for key commodities.
Recycling demand. That's the ESG and supply chain story creeping in again?
Exactly. Investors are tracing how raw material deals feed the supply chains for energy and industrial projects. Recycling reduces reliance on primary supply and shows up as a structural demand driver for certain materials.
And industrials, another CapEx winner. Tell me about that $1.2 billion plant.
The plant commitment in Texas fits the reshoring and plant modernization trend. It directly supports local industrial activity, creates jobs, and lifts demand for upstream materials and specialty suppliers. For regional service providers, that sort of commitment widens near-term order books.
Yeah, that tracks.
Right.
Now, we can't ignore the other side of the tape. Some sectors had a rough recession. Walk us through real estate first.
Real estate saw downside pressure on underwriting and credit concerns. A HUD audit flagged reverse mortgage risks, and private credit stress was amplified where ownership is concentrated, sometimes even tied to crypto holdings. That combination increases lender scrutiny and can compress liquidity for certain property types.
Reverse mortgage flags are the kind of regulatory red flag that reverberates, right?
Yes, FHA or HUD audit flags often trigger follow-ups and tighter underwriting, which in low liquidity conditions can mean quicker repricing of securitized property exposures.
Crypto also had a mixed day. Institutional buying, but legal trouble.
Correct. There were institutional inflows and new funds, even a reported $3 billion convertible deal, but that was balanced by legal pressure on major stablecoin issuers and a security incident with a cross-chain messaging provider. Net effect? Heightened volatility and risk premia.
So some structural demand, but headline risk keeps traders cautious.
Exactly. The market treats crypto as event-driven right now, institutionally interesting, but legally fragile.
Utilities were a mixed bag too, right?
Yes, faster permitting in places helped clean power projects, but operational strains on grids, state rollback headlines, and some coal pollution stories left sentiment fragile. So while some utilities benefited from project finance wins, Others had execution and policy risks to digest.
Technology had a split day as well. Kioxia posted record profits and is planning a US listing, but there were data exposure headlines elsewhere.
Right. Kioxia's strength underscores resilient demand in memory and storage. At the same time, a hotel check-in vendor exposure put 1 million identity documents into the headlines. There was also that $1.4 billion quantum funding round. So pockets of tech strength. But security and legal issues keep the picture bifurcated.
Honestly, I was a bit surprised by the breadth of that tech funding round.
Yeah, that tracks.
Healthcare. Clinical reads looked constructive, but regulatory shadows remained. Give us the specifics.
There were a couple of meaningful clinical updates. An antiviral with roughly a 2/3 risk reduction in its readout, and a radiopharmaceutical showing preclinical remissions. Those materially change approval probability and deal math. That said, ongoing regulatory reviews and Department of Justice probes for some names mean headline risk is still elevated.
Okay, so clinical wins, but the background legal noise caps enthusiasm.
Correct.
Communications and media had selective tailwinds from Cannes and film incentives. Brief comment?
Content momentum at festival season and network investment news helped select names. But it wasn't broad market leadership, more of a spotlight on particular franchises and deals.
Let's unpack the cross-sector themes. What correlated best across sectors today?
Several threads. 1. CapEx and project finance drove cross-sector positive correlations across energy, materials, and industrials. 2. Policy and permitting were the proximate drivers for energy, utilities, and real estate. 3. Legal and regulatory risk bound crypto, parts of healthcare, and some tech. And 4. AI and digital infrastructure continue to cross-pollinate sectors. Think data centers and interconnection demand.
Quick example on the AI thread?
Bill Ackman's disclosed stake in Microsoft and strong fundraising into AI infrastructure is redirecting capital into data centers, which then affects utilities, materials for construction, and industrial suppliers. It's a chain reaction.
Activism meets AI. Interesting combo.
Absolutely.
Okay, deep dive into the most significant moves. Run me through the implications of each.
Anduril's $5 billion raise could accelerate procurement timelines for autonomous systems, lifting industrial capex for suppliers. The $13 billion Commonwealth LNG FID means years of construction revenue for engineering and materials firms, and it shifts longer-term throughput assumptions for gas flows. The $1.2 billion plant is a concrete sign of reshoring and plant modernization trends, positive for regional construction and supply chains. The $239 million royalty deal in materials gives explorers liquidity and could accelerate drilling. And in tech, Kioxia's record profits suggested a resilient hardware cycle, while that $1.4 billion quantum round highlights pockets of high-conviction investing.
What about the market implication for crypto and real estate moves?
For crypto, institutional buys and fund launches increase liquidity and structural demand, but legal actions and security issues keep tail risk elevated. For real estate, HUD audit flags and private credit stress mean lenders will likely retest covenants and tighten underwriting. That can cause selective repricing in securitized property exposures.
Let's be practical. For listeners, what were the key actionable insights today? Informational, not advice.
First, tilt watch lists towards sectors where CapEx translates into contracted near-term cash flows. Energy project contractors, selected industrial suppliers, and materials companies could see backlog visibility improve after major FID and plant announcements. Second, price in regulatory and underwriting risk for real estate and credit-sensitive assets. HUD flags and private credit stress can force tighter covenants. Third, treat crypto allocations as event-sensitive. Institutional demand exists, but legal and security incidents are volatility multipliers. Fourth, watch energy permitting and EPA shifts closely for renewable project timing. Permits change cash flow timing. Fifth, monitor healthcare clinical and regulatory cadence. A roughly 2/3 risk reduction readout can reprice a binary, but regulators and probes can offset that. And finally, keep an eye on tech profitability signals versus security risk. Strong hardware profits coexist with data exposure headlines.
Good checklist. What should people watch next week? Quick scan by sector.
Energy. New FID announcements, contracts, permitting updates, and commodity reactions like uranium and natural gas. Materials. Royalty deals, drill results, recycling indicators, and export control chatter. Industrials. Order backlog updates and supplier delivery schedules. Real estate. Private credit covenant tests and HUD follow-ups. Crypto. Regulatory filings, CFTC notes, stablecoin litigation, and security post-mortems. Utilities. EPA permit implementations and data center interconnection demand. Healthcare. FDA minutes, trial publications, and any DOJ actions. Tech and communications. Profit updates, security breach disclosures, and large strategic stakes or activist filings.
Before we wrap, any underrated sleeper takeaways you want listeners to remember?
2 things. 1. When private and corporate capital is willing to deploy at scale, it tends to benefit suppliers and materials more broadly. That CapEx effect can be underappreciated in headline weeks. 2. Legal and underwriting shocks can reprice assets very quickly, so liquidity and covenant structure matter more than ever for credit exposures.
Solid. Quick reactions, under 10 words each.
CapEx momentum is real.
Regulatory risk remains the wild card.
Event-driven crypto flows continue.
All right, Ben, wrap it up for our listeners. Top 3 takeaways?
1. The day reinforced sector divergence. CapEx-heavy sectors outperformed, while legal and underwriting risks pressured others. 2. Final investment decisions and large plant commitments translate into multi-year revenue streams for suppliers, which supports materials and industrial order books. 3. Ongoing legal, regulatory, and underwriting episodes in crypto, healthcare, and real estate mean higher volatility and the need to watch cash flow timing and covenant structures closely.
Good closing notes. Quick reminder, this is informational only, not personalized investment advice. Analysts note observed activity and provide context. Individual investors should consult a licensed advisor to align decisions with their circumstances.
Exactly. Nothing here is a recommendation to buy, sell, or hold any security. Just market interpretation and signals to watch.
Thanks for joining, Ben. And to our listeners, if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. That's stockalpha.ai. Thanks for listening to Alpha Recap. We'll catch you next time.